Gabriel Yap, thanks very much indeed for joining us. Is this deal going to actually go through, do you think?
Well, it's basically up to a lot of opposition, particularly in Australia. The last time when I was actually back in Melbourne, that's about 2 months ago, essentially, it's still very much a talk about deal pertaining to clearing the key legislation as well as actually up to the Treasury to decide. But I think essentially it's very strange, you know, in Australia, most of the common people as well as actually the people in the banking circuit would really want the deal to go through simply because it actually rips a bountiful amount of synergies. But for the people, that's basically at the decision-making level, particularly at Treasury, it does seem that this is a deal that's seen more as a country opposition as opposed to an economy, a pure economic kind of a deal going through. For the reception in Singapore, I think most people are just looking at the share price of SGX to actually dictate, you know, what is the likely course of event.
You mentioned some of the synergies, but really, how much are we talking about here in real terms?
Well, essentially, when a deal between ASX and SGX, when it first actually came out, I think if I do recall, I was actually on Bloomberg to say that essentially I don't like the deal. It is actually a deal where there's basically an economy's only pertaining on the cost savings. I think the figure that was actually put forward was close to about 200 million over a period of 5 years. Now, essentially, there's no synergies at the revenue level. Essentially, it's just savings, of course. But as you can see, between then and now, SGX share price has actually taken a hit by $2 from $10.50 down to the current level of $8.30. The fact is that if you're going to put more things in place pertaining to help pacify the Australian legislation as well as the Treasury, then essentially the so-called touted amount of savings amount that's going to come through initially may not even come through, you know, close to that amount. So essentially the cost savings will be really minimal. I think the benefit that was put forward was that it actually opened up the arena for Singapore investors to actually trade commodity stocks. Now, to me, basically, this doesn't really sound fabulous because I think most of us, particularly the more sophisticated funds and institutional investors, will already trading the big boys like BHP, Western Petroleum, Rio Tinto on international markets.
Gabriel, I mean, it strikes me to some extent that this move by the Singapore Exchange is one really about getting size, and you know, with that size, of course, presents a lot more opportunities, doesn't it?
Well, with respect to the getting closer to size, with respect to the differential between the top leader right now, especially the Hong Kong Exchange and Singapore Exchange, I think it's probably one of the reasons. One has to actually look in retrospect, and in 10 years, in the last 10 years, Hong Kong Exchange used to be 3 times the size of Singapore. Right now, in terms of market cap, that actually widened to about 4 times or 4.5 times. So hopefully that the ASX proposed merger between the ASX and SGX may actually narrow that particular gap. But with respect to actually real benefits, to actually open up the synchronized platform for investors in Singapore in particular, so I don't think really that it's necessary to have a merger of the platform. I think essentially many of us, when we want to trade ASX, we normally, or rather ASX stocks, you know, you'd be surprised at some of the liquidity for some of the embedded mineral companies, for example, like Rio and BHP, will probably be more liquid than, say, in London than compared to, say, in Australia.
Gabriel, thanks a lot for that.